Hi, everyone. This is Tony Nash with Complete Intelligence. Thanks for joining us for another quick hit. Today, we have Tracy Schuchart and Sam Madani, and we're going to talk about crude and global trade and commodities and how long will this kind of updraft in prices last. Tracy, can you take a few seconds and let us know about your background and kind of what you're doing, please?
So I write for Hedge Fund Telemetry. I am the energy and materials strategist. And then I also manage an energy and materials portfolio for a family office.
Perfect. Thank you. Sam, can you give us a little background?
Yes, I am the co-founder of tankertrackers.com. We're an online service that keeps track of oil that's being shipped around the world. And my specialty is the tricky tankers, the ones that don't like to play according to the rules.
Great. I love seeing both of your Twitter feeds. It's always, every day I check them. Guys, I wanted to talk today about, we've seen kind of an uplift in crude prices. We've seen things like copper prices come down. We've seen natural gas prices, really start to see some upward pressure recently. At the same time, we're seeing talk about the JCPOA and some other Middle East type of changes with OPEC Plus and UAE and Saudi. So, I'm really wondering kind of what your thoughts are primarily on the crude and natural gas markets, but we can talk about commodities generally. So I know that's a big, wide open question, but Tracy, do you want to give us kind of generally what your view is and kind of what some of your positioning is at the moment?
Well, I'm very bullish commodities, as you know, particularly industrial metals, base metals, and minerals needed for this energy transition, right? So copper and things of that nature. We have seen a little bit of a pullback in a lot of commodities, which is not surprising. We had such a large move up. However, everybody's looking at this as a group, like the CRB index, right, has pulled back. But if you look at individual commodities, I mean, you're still seeing iron ore at highs, steel at highs. So they're not all, it's not like a whole commodity collapse. You're still seeing strength in a lot of different areas. So my positioning is instead of, indexed, I'm positioned in individual stocks, and particularly on the miners side. Great. Because miners are going to have the same problem, the CapEx problem that the oil is having.
Okay, that's a great point. Sam, what's your view? Like generally with say energy, what's your view and kind of what's driving that?
I remain bullish when it comes to oil in particular, and I pretty much pat myself on the back for having gone long at the end of March last year, when the mutual funds were at the all-time lowest in regards to oil, and that's come up quite a lot since then. I do believe that we will probably find a good footholding now in the 70s. And in order for that to remain, I think something drastic is going to have to happen on the upward. Probably scathe $100 and come back down so that OPEC can look like the good guys in the mid-70s, I would say. So I think also because of the fact that there's a CapEx shortage in the oil sector, they need this kind of revenue to come in order to sustain production as well. So I think that I'm looking at my original intended investment horizon was around 3 to 4 years. I'm going to probably be cutting that short until September of next year, I would say, because the issue that we have now is that the lockdowns are still in effect in many areas, but also comes to Europe, where I'm situated, most of the inoculations have only gone through their first phase. So we're still waiting for the second shot. And therefore, this summer will be delayed. I mean, we're not going to be traveling everywhere like we were in 2019. Instead, that will happen most likely next summer. So I think there's still one big run up towards a three-digit oil price, and that would be most likely happen next year rather than now. Yeah.
Great. Okay. So you brought up OPEC. So there's been news this week around OPEC Plus and a deal with Saudi and UAE and some other Middle East dynamics. What's your view on that? How much downward pressure will that put on crude markets, guys?
Tracy, go ahead.
I was going to say, you go ahead. You know, I mean, I think that, you know, again, right now, I think because of those factors in the Middle East, because I am of the belief we will see a deal and we will get some more barrels on the market. The market is actually very tight right now. But we're also having lockdowns in some places, Asia. So right now, you know, we already are seeing kind of a pullback in crude. And so I think, you know, right now, until we get a little bit more certain, you know, that 65, 75 range will probably hold us for a while. Like I'll see some consolidation there. And after a $115 move, you know, from the lows last year, it kind of makes sense for oil to, you know, kind of chill out and consolidate here a little bit.
Okay. And Sam, what's your view on the kind of OPEC Plus, Saudi, UAE, and other kind of OPEC countries wanting to tag along on the UAE expansion?
I think one issue that they themselves want to know is the status of the JCPOA. They really want to know how much of issue Iran will be if their barrels come back to market. Now that's a big if. But if we look at what happened during the Trump administration, the United States pulled out of the deal, and that was not good optics for the US side. But now what's happened is that Iran is not complying with the deal. So the ball is now in their court instead. So the Biden administration is saying, yes, the United States wants to be part of the deal, even though it's not a very popular deal in the US. I don't see any real popular support for it. It's more of a, let's just get back in there so Iran can improve its compliance, but they're not improving their compliance. Instead, what they're doing is going the other direction, and they're increasing their enrichment. They're becoming more brazen about how they move around the world with Navy vessels and so on. So I think and now, of course, there's a hardline president that's going to take office in August. So I think the deal will probably fall apart instead because of the fact that Iran is not complying.
Okay, so if the deal falls apart, does that kind of chaos help oil prices, meaning rise, or does it create the perception that there will be a dramatically larger supply in the market?
I think, well, of course, the initial reaction will be that, these barrels are not going to be re-entering the market, therefore the price will go higher. So that's the first automated response. But then, you know, the dust will begin to settle after a while when there's an understanding of what kind of barrels are not entering the market. So in Iran's case, they are shipping sour crude. Whether if it's light or heavy, it's sour. In order for that oil to become sweet, which is more attractive, you have to desulfur the oil. And so Iran, what they do is they give you a discount. If you want to buy a light sweet oil, but you end up buying light sour oil, Iran gives $10 discount, for instance, and then they just remove the sulfur at the refinery at their own expense. And that's what's causing, for instance, West Africa to lower their exports. So they're moving out a lot less oil now out of Africa than before on account of China buying more Iranian oil instead.
Mm.
I
Okay.
mean, I think what people forget, I mean, there's already a lot of Iranian oil on the market,
Right.
in the gray market and whatever. So even if they came back at, production of, 4.5 million, it's not really a lot of extra added barrels that are not already on the market.
Exactly.
Right.
And it will be absorbed by the demand that's coming, of course.
But it seems to me the kind of perception of legitimacy that would come through the JCPOA may calm prices down a bit through the kind of perception of legitimacy of that supply. Is that?
Yeah, I mean, I think, yeah, if it came to a fruition, which I don't foresee it, I have to agree with Sam on this point. But yeah, the market would think, oh, okay, we have all these barrels coming on, even though there isn't. And then it would be a numbers game from there. Then you'd have to see supply and demand numbers from the various agencies' monthly reports.
Okay. Okay, great.
And nothing also happens overnight. So even if the decision does go through, that, for instance, the JCPOA happens and Biden finally signs, for instance, initially a waiver, the whole process takes forever to reboot again. We saw it last time. Remember, Tracy, back in
Yeah.
5 years ago. It took many months. And also, in the case of Iran, they have most of their domestic national fleet is tied up containing gas condensate. So they have around 70 million barrels of gas condensate floating, and that uses up nearly all of the VLCC supertankers, the ones that can carry 2 million barrels. So what Iran has done is they bought additional vessels, vintage VLCCs. So now they have 200 vessels as opposed to 70. And those are the ones, the foreign flagged vessels that are moving the oil, mostly to China.
Okay, great. Okay, so you both mentioned lockdowns earlier in the conversation, and I think the tone here is that we have a pretty strong basis for rising crude prices. But we've seen some moves over the last week in the Netherlands and California and other places for maybe not full lockdowns, but more severe compliance with masks and other things. So, and that seems to be leading toward potentially some lockdowns. First of all, if there are lockdowns coming, what would be driving that? And we all know about the Delta variant and stuff, but are there political factors that would be driving that? Second of all, if there were, how would that impact, say, the 6 to 9 month view of crude markets for you guys? Tracy, do you want to start on that?
Well, yeah, I mean, I think we have, the United States is so big, I don't believe that they're going to lock down the whole country again. It just won't happen. And I think you would literally have riots on the streets in some places. So I don't foresee that happening. I could see some of the states like California just reinstated their mask mandates, right? I'd be watching, those states that kind of had more severe lockdowns to begin with, Michigan, to see if perhaps they lock down it again in the fall. Would probably be more politically motivated, I'm inclined to say. but we'll have to see. I mean, see what the numbers are and whatnot. As far as my crude view, I'm very bullish crude, but that doesn't mean like I'm expecting $100 tomorrow. So how I'm vested is longer term. So I'm vested for at least the next 5 years. So, and I do believe that if we get through the fall and we don't have lockdowns in the United States, and it seems that we don't see any further happenings in Europe, and Asia kind of comes out of that, then I definitely think 6 to 9 months, we're back in the swing of things, right? Because that'll put us right to basically next spring when oil demand really starts, right? So
Great. Okay. Sam, what's your view in Europe on lockdowns? Do you see that stuff coming back, and how do you see that impacting consumption?
So I would think that it would be mostly in the countries with a high population density. So Germany is obviously one of those countries, and UK is another. In other countries, not so much the case. I live here in Sweden. We never had lockdowns. We had it for seniors living in retirement homes and so on. But at the end of the day, we pretty much met the same statistic level as every other country. 10% population suffered through it, 1% or so, or less perished as a result. But I don't think that we'll be seeing any big efforts on locking down entire countries again. And what's more interesting now is school is coming up in a couple of months, or in at least a month and a half. And I think, I know here in Sweden, life will pretty much continue as is. So we never, I have 4 kids and none of them missed more than a week of school throughout the entire ordeal since 2020.
So it sounds to me like you both see there may be some lockdowns kind of at the edges, but it doesn't sound like it's something you expect to affect kind of the mainstream. And you don't see, maybe we see a slight dip in kind of the rate of rise of demand, but it doesn't sound like it'll have a huge impact to the downside on energy prices generally, whether it's crude or nat gas or something like that. Is that fair to say?
Yep, absolutely.
Very good. Okay. And then when it comes to natural gas, Tracy, I know you've been talking about that a lot lately. Can you tell us a little bit about your observations and your thesis and what you're seeing there?
Well, really, for natural gas, the reason I like it is it's a great transition fuel, right? So it's, and especially for emerging markets, because it's very inexpensive than to go, straight into something like solar or wind, just because of the cost of those minerals and metals to make those are skyrocketing right now. So natural gas, it's abundant. It's a great transition fuel. It's cleaner burning than oil. We just saw the EU, their big Green Deal. They just stepped back and now are including that gas, whereas before there was no oil or gas, because I think they're also realizing that it's inexpensive, it's a good transition fuel, and there's still, if you look at Germany, there's still a lot of coal going, in Germany. So for them, for Europe, it's not like fossil fuels are gone. So I think they realize also it's an inexpensive transition fuel. In particular for the United States, what I like right now is we're seeing European nat gas, TTF, and JKM, which is Asian nat gas, are trading at significantly higher than the United States is right now. And so I think there is opportunity there because, the U.S. can export and still come in at a lower cost, even with the cost of transportation to Europe or to Asia.
Interesting. Living in Texas, I have to say that I love that message. Sam, what about the tanker fleet? Is the global tanker fleet ready to provide the capacity needed to power EMs with, say, American nat gas or Middle Eastern nat gas?
Well, NatGas, I haven't checked too much, but tankers in general, the demand is not that great right now. When I say that, I mean that usually they really step up to the plate whenever there's a floating storage opportunity to talk about. So you had that case in Q2 of last year, and that really drove up the prices from the going normal rate of $20,000 a day to $500,000 at spike. And it's come down so much, and so complete occupancy is far lower than what I normally see. If I talk about deadweight tonnage, and it's around under 40%, which is very low, I would say. When we were looking at April of last year, it was around north of 55, close to 60%. So it's a big swing. And that really crushed the prices for. So when I look at tanker rates, they're even negative, so below zero. But when I look at the transfers of illicit oil, it's around $38,000 a day.
Okay.
So there's a lot of money to be made in those transfers, unfortunately.
Okay, we'll keep
But
that
for
in mind.
LNG, I'm not entirely sure, so can't say for sure.
Okay, very good. Guys, thank you so much for your time. This has been really helpful. I'm really intrigued by kind of the long bull thesis for energy. It gives me hope that we're going to start recovering much quicker than we had been, which is fantastic. So thanks for your time. I really appreciate talking with you guys. Thanks very much.
Thank you both.